how do you really get a handle on whether a stock's price is, off?
Yeah, it's tough.
It feels like a constant guessing game, doesn't it?
It really does.
But imagine having a new angle, maybe a way to see if a stock is truly a bargain or maybe ridiculously overpriced compared to, well, the rest of the market.
And that's where some pretty compelling new research comes in. It introduces this concept called the Price Wedge Shock, or just WS. It's from a paper by Peng and Xu, and it's a really clever attempt, I think, to pinpoint when a single stock's price really deviates, like significantly, from what the market on average values similar fundamentals at.
So like catching that specific moment of mispricing.
Yeah, trying to measure that moment when mispricing might be most apparent.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so instead of trying to nail down some absolute fair value, which honestly can feel like chasing a ghost sometimes, WS is looking at this market average value. Where does that actually come from? What is it telling us?
Good question. So the researchers lean on the Olson model. It's a pretty well-regarded framework. It basically helps us understand how things like a company's future earnings potential and the market's required return should affect its stock price.
Okay.
But then they do something really interesting. Every single month, they look at a huge number of stocks and they see how their actual prices line up with their fundamentals, earnings, book value, that kind of stuff.
Comparing them all cross-sectionally.
Exactly, cross-sectionally. And to make sure outliers don't skew things too much, they use this statistical method called Thielsen regression. It makes it more robust.
Makes sense.
So the price they'd expect for a stock, based on these broad market relationships they find that month, that's what they call the market average value.
Okay, so it's like a dynamic benchmark, constantly updated based on how the market is pricing fundamentals right now.
You got it.
And the price wedge is then just how far the actual price is from that benchmark price.
Almost. It's actually calculated as that market average value divided by the observed stock price. But yeah, it captures that deviation.
Got it. So a big difference there hints at potential mispricing.
That's the idea behind the wedge itself. But the real key for spotting potential mispricing in this paper is the price wedge shock. And that's simply the difference between the current price wedge and its average over the last 3 months.
So the change is the crucial bit. It's not just about a stock being consistently different, but a sudden shift in that relative pricing.
Exactly. That's the shock element.
So a positive WS means it's suddenly gotten cheaper relative to that market implied value. Undervalued, perhaps.
That's the suggestion, yes. A positive WS suggests potential undervaluation relative to its recent history and the market.
And a negative WS
Suggests the opposite, relative overvaluation. The whole point of looking at this change, the shock, is to try and filter out, those stable company things.
like maybe it always trades at a premium for some reason.
Precisely. Filter that out and focus on the new information, this shift, which might be a sign of, actual mispricing.
Okay, that theoretical basis makes sense, focusing on the change relative to the market. Now, this isn't just theory, right? They actually tested this.
Oh, yeah, absolutely. They crunched the numbers.
How did they test it? What did they find?
Well, their main approach was to build what's called a hedge portfolio.
Okay, long, short.
You got it. They essentially went long the stocks with the highest positive WS, the ones looking most undervalued by this measure.
Buy the cheap ones.
And simultaneously went short the stocks with the lowest negative WS, the ones looking most overvalued.
Sell the expensive ones.
Yeah.
Makes sense. And then they just watched how that basket performed.
Yep. They tracked the returns month by month.
And did it work? Did this WS strategy actually, predict anything?
The results were pretty striking, actually, over a really long period, too. April 1976 all the way to December 2023. They found a statistically significant positive link between this WS measure and how the stocks performed in the next month.
So high WS stocks tended to go up more, low WS stocks
Yeah.
less so or down.
That's the core finding. And the difference in returns between that long portfolio, high WS, and the short portfolio, low WS, well, it was pretty substantial.
How substantial are we talking?
It ranged from 0.53% per month for value-weighted portfolios,
Okay.
up to 1.20% per month for equal-weighted portfolios.
Well, wait. Over 1% a month on the equal weighted side?
Yeah, 1.2% per month.
But hang on. What about risk? The standard stuff. Did they account for market risk, size, value, all that?
Absolutely, critical question. And yes, they did. They controlled for standard CAPM beta, the Fama-French size and value factors.
The BHML.
Yep. And even more complex models like the Q factors, they really threw the standard factor zoo at it.
And did the WS effect disappear once you account for those known risks?
That's the key finding. It didn't. Even after adjusting for all these well-established risk factors, the predictive power of WS for next month returns remained statistically significant.
Wow. Okay. So it seems like WS might be capturing something beyond just standard risk premiums, something potentially related to actual mispricing.
That's certainly what the results suggest.
They also looked at robustness, right? Like, does this still work if you tweak things?
They did. They checked if it held up when excluding, say, really small stocks or penny stocks.
Which can be weird sometimes.
Exactly. And it still held. They also tried different look-back periods for calculating that average wedge, like 6 months or 9 months instead of 3.
Yeah.
Still significant. The 3 months seemed to work best, but the effect was robust to those changes, too.
Okay, so the signal seems pretty consistent. Now, this leads to the big question, doesn't it? If this strategy seems to generate these kinds of returns, even after risk adjustment, why doesn't everyone just, do it? Why hasn't it been arbitraged away?
Right. The million-dollar question in finance, basically.
Exactly. The paper talks about this, right? Limits to arbitrage.
It does, yeah. That's a core part of their explanation. The idea is that even if a signal like WS points to mispricing, there might be real-world frictions or barriers limits to arbitrage that stop smart investors from fully correcting it immediately.
Frictions. Like what? What kind of stocks or situations make it harder to trade on this?
Well, they found the predictive power of WS was actually stronger for stocks where you'd expect these limits to arbitrage to be higher.
Such as?
So things like smaller company size.
Right. Harder to trade large amounts.
Exactly. Also, higher illiquidity measured using things like the Amahud measure. Basically, stocks that are harder to buy or sell quickly without moving the price. Higher idiosyncratic volatility, so more price swings that aren't related to the overall market. More uncertainty, maybe.
Yeah. Riskier to bet on.
Lower institutional ownership was another one.
Fewer big players involved.
Right. And lower analyst coverage. Basically, stocks that fly a bit more under the radar.
So it's in these harder to trade, less watched, maybe riskier corners of the market that this WS signal seems to have the most predictive power.
That's what the evidence suggests. It makes intuitive sense, right? These are precisely the stocks where it might be too costly or too risky for sophisticated arbitrageurs to step in and fully correct any perceived mispricing flagged by WS.
Yeah, it does. Transaction cost, market impact, maybe just the sheer risk of betting against something volatile. It adds up.
Exactly. So while WS might signal a potential mispricing, actually profiting from it isn't necessarily a simple risk-free lunch. There are real constraints.
They also linked WS to fundamentals, didn't they? Something about earnings surprises.
They did, yeah. The idea is if a stock is truly undervalued, high WS, maybe the market is being too pessimistic about its future earnings.
So you'd expect positive surprises later.
That's the hypothesis. And they found evidence for it. Higher WS values were associated with greater positive earnings surprises in the next earnings announcement.
Measured how?
Both by the market reaction around the announcement, or EDICAR, and by the accounting measure, the Standardized Unexpected Earnings, or SUE.
Interesting. So it connects back to fundamentals being misjudged.
It seems that way. And the effect of WS was even stronger around those announcement periods, suggesting that's a time when some of this potential mispricing gets corrected.
Okay, that adds another layer. What about investor sentiment? Does the mood of the market play a role here?
It seems to. They found that the predictive power of WS, especially for identifying overvalued stocks, low WS, was stronger during periods of high overall investor sentiment.
So when everyone's feeling bullish, maybe things get more overpriced, and WS picks that up better.
That aligns with the findings, yeah. And the correction for those low WS stocks was more pronounced following those high sentiment periods. It fits with other research showing sentiment can drive prices away from fundamentals sometimes.
Right. Okay, so let's try and wrap this up. We've got this Price Wedge Shock, WS. It's basically looking at how a stock's current price compares to a market implied value based on its fundamentals, specifically focusing on the change in that comparison over recent months.
Yep, that's the core measure.
And the research suggests that going long high WS stocks and short low WS stocks has, historically at least, generated some pretty interesting returns.
Significant returns, yeah, even after adjusting for common risk factors.
But crucially, this effect seems strongest, where it's harder for arbitrageurs to operate smaller stocks, less liquid ones, less analyst coverage. The limits to arbitrage seem key.
Definitely. And sentiment seems to amplify it, especially on the overvaluation side.
It's a fascinating approach. It really shifts the focus from finding some absolute true value to looking at relative pricing within the market at a given time.
It does. And it leaves you thinking, doesn't it? Could focusing on this kind of market relative pricing, based on how fundamentals are actually being valued by the market now, be a more robust way to spot potential opportunities?
Especially compared to trying to pin down an absolute intrinsic value, which is notoriously difficult.
Right. And maybe the key question for anyone listening is, how could incorporating a dynamic market relative measure like WS, acknowledging those limits to arbitrage and the role of sentiment, potentially sharpen your own view of the market? Could it offer an edge?
It certainly highlights that market efficiency isn't always perfect, particularly in certain segments. Definitely gives us some food for thought.
Indeed. Maybe a topic for another time is drilling down into the practicalities, the real costs and challenges of actually implementing something like this.
That sounds like a great idea for a future deep dive. For now, thanks for walking us through this really interesting research.
My pleasure. Always fascinating to see new ways of looking at the market.